Welcome to our new video analysis where we will take a look at gold and silver. We've been covering metals over the past few weeks, and I can assure you that we'll focus on the metals in the coming months, if you like it or not, simply because I think the best or some of the best opportunities of this year will be precisely in metals like gold and silver. But before we start, let me remind you that this video is not investment advice, and if I'm gonna speak about specific financial instruments like futures, options, spreads, ETFs and others, it's always just for educational purposes. Our previous analysis 2 weeks ago was focused on currencies, but we also covered the precious metals. And we told you that we expected this consolidation on gold to be resolved by break higher, and we anticipated the price to move higher. That was true for the first week. There was a solid rally. However, the price then started losing momentum, and it was decisively rejected at $2,000. And although we did not originally expect the rally to last only a week, we at least expected to make a retest of a previous high. But once again, as we told you many times before, when the data changes, our opinion must change too. And that's exactly what happened. And we alerted you on our Twitter that gold is likely to enter a corrective phase, and this is about to take some time. The gold price has been moving down since then, but let's take a look at the current situation. So I will pick a few charts, I don't know, maybe that's all, and also these charts. Let's start with the gold price itself. This chart is the first continuous contract for gold in dollars to be precise. And you can see that after the strong uptrend, the price has been consolidating. There was an attempt to break $2,000 that failed, and right now we are in a corrective phase. Like I said, we will be covering metals pretty intensively in the coming months, but this stands in a stark contrast to the second half of 2021, when we basically ignored gold and we were not interested in those small rallies or drops, although people regularly become excited that gold is gonna move up and so on, but we were not interested. And there were two reasons for our stance. The first reason is the price action itself. As we told you many times before, gold behaves as a kind of a momentum asset, which means that it has no real use. So people buy gold only when they see its price going up. And when they buy the gold, the price moves even higher. So it's a kind of a reinforced loop. And when you zoom out, take a look at the weekly time frame, you can see that over the entire last year, the price of gold was moving sideways. However, that has changed recently, but I will get to it. So that was the first reason why we were not interested in gold in the second half of 2021. The second reason we disliked gold is on this chart. This is the chart of 10-year real yield, which is basically the nominal yield on US treasuries minus the 10-year break-even inflation rate. And normally gold correlates negatively with this chart. And over the past year, the real yield was moving around -1%, which was basically close to the local low from 2020. In other words, there was not much downside left. Of course, it is always possible for the yields, the real yields, to go even more negative, but probably not in the short term, or at least it was not likely in 2021. So the point is that risk reward on gold was not attractive at all. But if you look at these charts today, you can see that those two reasons are no longer true. The real yields are not so low anymore. They moved up and approached the zero level, which of course is not too high from the historical perspective. But you have to keep in mind that on a personal, corporate and also governmental level, the amount of debt has increased rapidly over the past few years. In other words, the economy can tolerate much lower real yields compared to the historical perspective. So while the economy could not have problem to handle 2 or 3% real yield in the past, that would not be possible today. I don't know where the maximum is that economy can handle, but I don't know if it is at the zero level or 0.5. I really don't know, but it is definitely much lower than before. The really weird thing in regard to gold is that it tends to correlate negatively with real yields. But that was not the case over the past few weeks and few months, because as the real yields increased, the gold price moved higher too. So that's kind of an anomaly, and it will be interesting to see how this how this gets resolved. One explanation is that gold is simply lagging behind, and the divergence will close by gold moving sharply lower and catching up with the real yields. But the second opinion or second explanation is that gold is in fact right by discounting the future economic conditions and yields and so on. So basically that when the real yields turn lower, the gold price will continue to move up. I don't know what happens because it's very difficult to predict this, but I definitely like the fact that real yields are no longer so negative, which means that future risk reward for gold is definitely better than it was a few months ago. And now we are back to the price chart for gold and dollars, and as I said, a positive momentum has been established in gold. And that's the second reason why we like gold right now from the long-term perspective, because even though the price can move lower in the short term, our willingness to be wrong in the short term is much greater now when the momentum is clearly positive. As long as this is true, we will consider any correction in gold price to be a buying opportunity. And although I personally dislike gold as an investment or precious metals in general, but this is really subjective, it's my own opinion, I really like gold as a trading vehicle. It is one of my favorite underlyings, and some of the best strategies I ever made were in gold. They were mostly option strategies, but I really like it as a trading instrument. There is a lot of ways to trade gold, not just futures, but also ETFs, and these ETFs are very liquid, and there are also liquid option markets on these ETFs. So really great instruments for trading. So that was the long-term outlook, and now let's focus on the short term. As we told you on Twitter, gold has entered a corrective phase, and we think it will last for some time. I mean, it won't be something that gets resolved in a few days or a week. Most likely it will take a few weeks at least. And maybe you wonder how low the price of gold can fall. And this is really hard to guess. You know, these are just these estimates of target price. I don't like it because it rarely works. It's better to always use the current data like we did a week ago to recognize that the gold has stopped in the short term. So we will, stick to our framework. But in order to just, make some guesstimate, I think the gold will most likely retest the apex of the previous consolidation, which is somewhere between 1800 and 1850. That's the most likely target in my opinion. Maybe it will go just to 850, or maybe it will go below and go to, I don't know, 700 something. But it is crucial for gold not to create a lower low. So I definitely do not want to see the gold price to move below $1,700, as that would most likely invalidate our long-term bullish outlook. But like I said, the most likely target in my opinion is between $1,800 and $1,850. When we take a look at gold priced in euros, it looks very similar. The gold in euros has been much stronger over the past months, but even in euros, the gold price failed to create a higher high and is rolling over. So I don't know where the price can fall, but the retest of the previous consolidation between, 1640 and 1570 is likely, in my opinion. Let's take a look at silver, because I think it will be much more interesting for silver. As we told you last time, we think silver will lag gold in performance in the upcoming period. While we do not expect the gold price to move below the recent lows, lows from the past consolidation, I suspect this will happen in silver, because there is a lot of stop losses below these levels, and a quick flush below, $21.50 will most likely reset the sentiment on precious metals, and it would be very healthy in the long term. So my base case is that the price will move at least to $21, or basically somewhere in this area between 21.5 and $18, because once the price start moving lower, it can become really volatile. So there can be some kind of sharp spike lower that will last only a few days, but can be really brutal, like we saw in spring 2020 and even many times before. But generally, I think the era between 20 and 21 is the most likely target, definitely below the previous lows. If we take a look at the price of silver in euros, it is once again very similar. Here the crucial support is at 19 euros, so I think it would be really healthy if the price moves below this level. We can zoom out to the weekly chart, and the area between 17 and 19 euros would be the best or the most likely target. And once again, I remind you to take these targets with a grain of salt because, we prefer to be flexible, to stick to the current data and not to be constrained by some artificial targets we set weeks or months before. So these are just, potential targets. It would be great if the silver price undercuts the previous lows from this consolidation. It would be healthy, but if it doesn't happen, we wouldn't care. Now, you might wonder how to trade this short-term move, the short-term correction in precious metals. In fact, shorting gold or silver might not be the best idea because, as I told you, we think these markets have resumed their longer-term uptrends. We are bullish longer-term based on the real yields action and also the price action in gold. So going against the long-term trend is usually not so smart. It is much wiser to speculate in the direction of the trend. So if you decide to pass this short-term correction, I think that's pretty wise. However, there is one strategy that presents better risk reward than shorting the gold or silver itself. And it is the gold-silver ratio, or the spread between gold and silver. Here's the ratio. You can see the nice consolidation over the past half a year. There was a false breakdown recently in the middle of April, but as you can see, the ratio has broken higher and it seems to be a decisive break this time. And I do expect this ratio to continue to move higher. That would fit perfectly to our expected correction in gold and silver, because usually, not always, but usually when this ratio moves higher, the price of gold and especially silver moves down. And given the fact that this was really a long consolidation, as I said, it lasted half a year basically, I do expect the subsequent move to be significant. It won't be something that will play out over the upcoming few days or a week. So in my opinion, it is likely that the ratio will target the level around here at 90. That would be pretty symmetrical with the consolidation and the run up to the consolidation. Once again, this is just a guesstimate. I don't know where it goes, but I expect the move to be significant. So it won't move up to just, 81, 82. I think it will really move at least to 85, most likely to 90. The reason I like the 90 level, or I suspect that the 90 level is where the ratio goes to, is because of this chart. This is the same chart, but on the top we have the distribution of the ratio, the histogram, which is very useful for these kinds of intermarket spreads or ratios. And you can see the cutoff beyond 90, which means that the 90 or roughly the 90 level will act as a resistance for the ratio. The 95th percentile is also close to the 90 level, so it makes a perfect sense that the ratio will move somewhere to around here. All of this would fit together really well, because if you assume that the gold-silver ratio will go to 90 and the gold price will move down to 1800, maybe 1850, then if it goes to 1800 and the 90 gold-silver ratio, that would imply a silver price of $20. If the gold price moves to 1850 and the gold-silver ratio moves to 90, then it would imply a silver price somewhere slightly above $20. I don't know, 20.5, something like that. So this is really in the target area we mentioned before, definitely below the previous lows from this consolidation. Once again, there can be volatility, there can be spikes lower, but I think it definitely makes sense. On the other hand, do not stick to these perfectly outlined scenarios too much, because it might not play out as we expect. So we will definitely prefer to take a look at the data, and especially the model on SpreadCharts for gold is really great. I suspect it is one of the best underlying for our machine learning model. So there was a short signal on the highs at the beginning of March, and recently the signal was valid at 1.0 just before or just slightly after the price turned lower. So that was also very useful for you. So let's see how this evolves. And now let's think about the way to actually trade the gold-silver ratio moving to 90. One possibility is to use the liquid ETFs for gold and silver by buying the gold ETF and selling short the silver ETF. Or there are even inverse ETFs for silver, so this would work pretty well. Or we can use options. I would personally prefer the vertical spreads, because the outright options, especially the out-of-the-money options, are no longer so cheap given the uptick in the implied volatility. The in-the-money options might be good because it's a way to, save margin. So instead of buying or selling the ETFs, I can buy the in-the-money call and put options. So this is definitely doable. Or there's the third way, which is through the intermarket spread, future spread on or between gold and silver. And you can see this spread on this chart. And by the way, this is the so-called equity form of the spread, which means that I multiplied each leg of the spread by its corresponding point value, which is 100 for gold and 5,000 for silver. And the result is that the y-axis is in the dollar terms, or the movement of the spread on this chart corresponds to the dollar movement. And there is one thing you can clearly notice. The spread can easily move by $10,000 in a matter of day or two. So it is very risky. It is only suitable for really large accounts, most likely institutions. Moreover, there is not just one but two multipliers for silver. The 5,000 is for the point value, as I said, but the number 2 stands for 2 contracts. The spread is normally imbalanced because the value of the gold contract is nearly twice as large as the value of the silver contract. So that's the reason why I think it's better to sell 2 silver contracts and buy 1 gold contract, so the spread becomes more balanced, or the value between the legs of the spread is more balanced. And that's it. I think this intermarket strategy looks really good. But keep in mind, it's a short-term opportunity, because in the long term, we turned bullish on precious metals, and that's most likely not compatible with this spread. As I promised, we will watch the precious metals really close in the upcoming months. We plan to do a dedicated analysis on platinum in the future. And we will also try to let you know once the precious metals, especially gold, bottoms in the upcoming weeks or months. So keep following us on Twitter and watch our research so that you are up to date with the latest info. And thank you for watching us, and see you next time.